Hey folks, what's going on? Welcome to the YouTube channel. Hope you're doing well. This is going to be a little bit of a weekend video. I'm going to talk to you about a few things today. Let's talk about derivatives trading, options contracts, futures contracts, short-term trading, the kind of stuff that I'm into here. So I've been thinking about a few things. In regards to my current style of trading, I think I will likely be switching to a form of futures trading instead of options contracts. And I'll tell you why. So let's talk about some of the risks and characteristics of options contracts and options trading in general, okay? So the most important thing in regards to options is implied volatility. So when you go to an options chain, you see the prices that are being displayed for the option, but what you need to be more concerned about is the implied volatility of that option, all right? And I'll tell you why. Because implied volatility is simply the forecast of what the VIX volatility index is implying over the life of the option, okay? So for example, let's say this option right here, now the market's closed, but normally you would see a percentage here telling you the expected implied volatility of the underlying. Now, there's big problems associated with this, especially if you're looking to scalp trade these options. It depends, right? Because you can have extremely tight stops, and depending on if you're trading a highly liquid market, generally you can probably get away with doing this. But I'm making the realization now that I think I'll be a lot better off in the futures market simply because liquidity is even less of a problem. There's no games that the market makers play with futures. Futures are highly regulated, and for example, there's no occurrences where you'll get a certain option that's being underpriced or overpriced based on the demand or supply of that option, and then it's being propped up because somebody's making their own trade a winner, right, at the end of the day. And that's kind of what I've been realizing lately in regards to the options market, is that it seems like a tool that firms, big money, is using to make their own trades winners, right? One thing I've noticed is that the option strikes that trade the most volume during a trading session, those are the ones that tend to expire worthless, all right? I was watching the 300 puts on the spiders yesterday, and they were trading over 160,000 contracts around noon or so, and those ended up expiring worthless. What do you know? It got tested though. I think SPY traded as low as 298 or something, but at the end of the day, those contracts still expired worthless because there was too much volume there that someone needed to compensate for it or something, and basically they expired worthless. All right, so let's get back to volatility, what I was just talking to you about. So the reason why options trading is extremely hard for short-term trading is simply because of the implied volatility factor of the option. All right, let's look at a 15-minute chart here. Okay, so just take a look at this. Let's say you get long some out of the money calls, right? You're buying calls here, you're in profit, and then oops, you see a little pullback. Now, by the time the market gets back up here, because the market endured this pullback and is now coming back, if your options are still out of the money, there is a great risk that you lost some premium in those options. Even when the price of your underlying comes ticking back up, there's a high probability that the option contract you're long is not going to be back to the same value that it was earlier. And the reason for that is because of the implied volatility of the market. So when the market does this, by the time it gets back to up here, that call is worth less here than it was over here. And the reason for that is simply because more time has passed, there is less of a chance that this option is going to expire in the money, all right? So the closer we get to expiry, the more sensitive an option contract is going to be to choppy price action, right? Because the more time passes, the less likely it gets that the option is going to expire in the money, all right? The problem with long options is that there's not enough margin for error, and there's basically the odds are against you completely. If you understand that risk, then I think it makes sense in the long run to just switch to being an option net seller versus a buyer. So that's the basic idea. There's basically a very little margin for error if you're trading long options, all right? So if you're trading same day expiry or a couple days to expiry, that kind of price action, the price action that you'll get a lot of whipsaw moves and you're not really nailing all the moves, that is going to kill premium. For example, if you did it with just a straight up futures contract, you have more margin for error in the sense that if you endured a bit of a dip and then it came back to your break even, your position is worth the same value. It's not worth less. So that's the advantage of futures trading. Now, again, another advantage of futures trading is going to be the fact that there's no problems with liquidity. You will always get filled at a price in the orderly market, okay? So there's none of this stuff where the market makers kind of hold the bids or they hold the price at a certain point until it's clear to them that they can move their bid and offer higher and then fill your order and then take the profit on it. With futures, this is highly less likely simply because of the vast liquidity of the market, and you're just not going to run into those problems. So at the end of the day, in regards to options trading, I honestly think that the real edge is in selling options. If you are scalp trading options, or if you are short-term trading options with a short amount of time to expiry, then there are a lot of risks in regards to the vol of those options, right? So any kind of choppy price action is not going to be working in your favor if you're trading long options coming close to expiry, right? So the ideal scenario is going to be if you buy an out of the money option and then it becomes in the money, right? You can obviously have huge returns with those kinds of trades. But the thing is that they often don't happen, and a lot of people are chasing those kinds of trades, which makes them even less likely to happen. The last thing I want to talk about real quick is how big money can utilize the options market to hedge themselves and to also make their own trades winners a lot of the time, all right? So think about this. If you were a fund manager and you had a certain amount of capital allocated to a market, right? Let's say you had $1 billion today and you were working with, your job is basically to provide an orderly market in whatever it is you're trading, but also you're making a profit off of this stuff. So people are coming through and buying bets off of you. They're buying SPY calls, they're buying SPY puts, this and that. At the end of the day, if there's no imbalance in the market, which you as the market maker, as the fund, as the money who's kind of running the show, you're going to be using all the tools at your disposal to make your trades profitable. So let's say you're a liquidity provider on any of the big options here, okay, SPY or the NASDAQ. You see where the volume is coming in, and you also have a pool of capital ready to allocate if you have to offset a certain position or if you have to buy and sell the market in a way that can make your trades be winners. And that's the thing, is that when you have a large enough amount of capital, you can essentially make your own trades winners. And that's what these guys are doing a lot of the time. So let's say they're short a whole bunch of these 310 calls. It becomes very clear at a point that when the option here is trading a huge amount of volume, and you can see that the market is having a hard time trading above 310, it becomes pretty obvious that somebody is out here trying to compensate for the fact that they're short a lot of 310 calls. So keeping that market relatively contained is a part of their strategy, right? And essentially making their own trades winners. When there's a lot of retail money flowing into the options market, it makes sense for the smart money to allocate capital to keep the market in a place where those bets will likely expire worthless. So that's the concept I'm trying to get across here. So bottom line, guys, when you see, always look at the implied volatility of the option you're trading, okay? So if you pull up and you're looking at these options here, 2 days to expiry, and you can see that this vol here is 1.7%, it basically means that these options prices are currently implying a 1.7% move. Understanding if that volatility is even likely to occur or not. And a lot of the time, it's not. That's the thing. So these options here, you're gonna notice that they're priced at a certain amount, but they're all time value. All the options that are out of the money are all time value. So basically, look, if you're trading options, if you want to have any chance making money trading options, you have to understand the edge, which is implied volatility. That is the edge in trading options. It's understanding volatility in the markets, realized volatility versus implied volatility. It's not worth it to scalp trade or to day trade options a lot of the time. But I'm realizing this because of the nature of the choppy market. As time goes by, if you stay in a trade a little bit too long, you're exposing yourself to too much vol decay. That's it, all right? Now, if you buy an out of the money option and it ends up in the money, that's a different story. At that point, you have an asset, right? So you have a contract that has a lot of intrinsic value, so generally that's good. But if you're trading a lot of out of the monies, then just know that you're playing with a lot of time value and you're playing with contracts that should technically be worthless if the market doesn't manage to get to where they are. So that's the thing to keep in mind with trading options and understanding decay with these options. So for every move that the market makes in a trading range, it becomes less and less likely that these options are going to move the implied volatility that the market is implying, therefore decreasing their delta, decreasing their premium, right? And this happens the most for at the money and out of the money options. In percentage terms, out of the money options will decay more in percentage terms, but in dollar terms, at the money options will decay more. All right, so that's enough about options. For the approach that I've been developing, I've realized that I will probably see more success in the futures market simply because of the better liquidity of the market and the ease of entries and exits of the market. So generally, I'll keep you updated on this as we go on here, but I'll likely be trading the NASDAQ futures, the micro NASDAQs, and I'll likely be trading these things instead of the Qs options. And that's it. So I'll keep you updated as things go on here, guys. Thanks for sticking around the channel. It's much appreciated. If you enjoy what I do, please leave a thumbs up on the channel. I will see you in the next video. Take care, guys. Bye.